Hey guys, how's it going? Welcome back. In order to effectively prepare for your LIBF Unit 1 exam, this is the fifth in a 12-part series that covers all 12 topics you need to know to be successful in your exam. Make sure you leave a like and subscribe for future related videos. In today's video, we're going to be looking at savings accounts, a vital topic to understand. Let's check it out. Within this video, we're going to look at why people save, how they should choose a savings products. We're going to look at what interest rates, base rate and AER are before we move on to how to get a higher savings interest rate. We're going to look at alternatives to traditional savings accounts as well as inflation and its effect on savings. So, why do people save? Well, savings are delayed or deferred spending, as savings are used for the exchange of goods and services at a later date. Now, we could save for a rainy day, we could save for an emergency, or have a contingency fund should that happen. We could also save for things that we want, things like a nice fancy holiday, or a new laptop. Many people save for purchasing a home. The first home purchase is likely to be one of the most expensive things you buy. So, in a nutshell, the reason why people save is to satisfy their needs, their wants, and their aspirations. Now, needs are most likely satisfied through everyday earning. However, wants may be people have to save up in order to afford things like nice holidays, for example. And aspirations, these are the long-term desires, things like sports cars, supercars, for example. People may have to save a significantly long time to afford these types of aspirations. So, do the reasons for saving change at different stages of the life cycle? Well, yes, they do, because at different stages we might have different wants and aspirations. For example, when we have kids, for example, we might wish to save for their university tuition fees. When we're approaching retirement, we might put a greater proportion of our pay away for our retirement. Why do some people find it easier to save than others? Well, some people are potentially, some may say, better with money than others, better at saving, but also it could be due to the fact that we're at different stages of the life cycle. Those with dependents may find it difficult to save because more of their money is having to be spent out looking after their dependents, for example. So, what factors do we need to take into account when choosing a savings product? We might wish to take into account what the rate of return is. If we're putting our savings with a provider, we might want to get a return, and obviously the higher the return, the better for us because our money will grow at a quicker rate. We also might wish to consider that is the rate of return higher than inflation? Now, as we know, inflation is running very high at the moment, about 10 or 11%, so the rate of return of a savings account, for example, is unlikely to be higher than it. However, in this case, we may wish to go for more risky types of savings or investment products in order to try and beat the level of inflation. Otherwise, our money is essentially eroding away in its purchasing power. We also may wish to consider whether we have to pay tax on the interest that savings earn. There are types of savings accounts that, of course, are tax-free, things like ISAs, which we'll come on to shortly. We may also want to consider how often we'll be able to withdraw money. Some types of account, like one of the accounts in the recent January 2023 Part B exam, was a triple access account, which means essentially you're able to make 3 withdrawals, but on the 4th withdrawal, your rate of return or your interest rate will fall significantly. We might wish to consider how regularly we want to save. Some savings accounts stipulate that you have to make a certain amount of deposit each month, for example. So if we're unlikely to be able to meet those criteria, then it's no point in us choosing that account. We might wish to know how we'll operate the account. Oh, will we go into store to operate it, into branch? Will we do it online? Some accounts are online only, for example. So if we are wanting to go into store, into the branch, then that type of account would not be suitable for us. We also want to ensure the safety of our savings. Now, the vast majority of savings accounts will be covered by the FSCS, the Financial Services Compensation Scheme. So for that reason, they will be safe up to the value of £85,000 should the provider go into liquidation. However, there may be investment products that we could choose which there is no guarantee of our savings being safe. So therefore, it really depends on our attitude to risk, whether we're risk averse or more open to taking on risk. So some key terms we'll need to be aware of. Firstly, the interest rate. The interest rate is the cost of borrowing. So if we borrow money from a provider, that is the amount extra we have to pay back on top of the amount we've borrowed. But it's also the reward for saving, for lending to a provider. Essentially, the way that banks make their money is that we, as savers, give our savings to the bank and then they lend that money out to borrowers. And they, of course, charge borrowers a higher interest rate than the interest rate they give to savers. The base rate is the interest rate which is set by the Monetary Policy Committee, or MPC for short. Now, the Monetary Policy Committee is a subsidiary or a part of the Bank of England, so it's not government controlled. It is simply an organisation which is responsible for setting the interest rate. What influences the interest rate? Well, things like the level of inflation, the Monetary Policy Committee will take into account when setting the interest rate, otherwise known as the bank rate. A nice easy way to remember that the Monetary Policy Committee set the interest rate is that monetary has 8 letters and of course interest also has 8 letters. Now, the AER, the average equivalent rate. What does this mean? Well, it's the interest that will be earned on the money in 1 year. When we are comparing between different savings accounts, all providers must use the same formula to calculate the AER. So it's a quick and straightforward way to differentiate and compare different savings accounts. So how do we get a higher savings interest rate? Several things we can do. Obviously, firstly, deposit larger sums of money. Many savings accounts say that up to a certain amount you'd get one interest rate, but over and above that value you might get a preferential interest rate. The second thing we might do is commit to adding regularly, monthly for example, to our savings. By adding regularly, we may benefit from a preferential interest rate from the provider, but also we'd be getting more interest because, of course, we'd be having more in the account. Another way we could get a higher savings interest rate are if we're prepared to leave our money in a savings account for a period of years. Many banks and building societies offer this option. Essentially, we are saying that yes, we are paying this money in and we're not going to touch it for 1, 2, 3, 5, even 10 years. Obviously, the longer we're willing to leave our money with a provider, that gives that provider a longer time to lend it out to someone else, and therefore they're more willing to increase the interest rate that they pay us as a reward. And a fourth method to get a higher savings interest rate is to accept certain restrictions on the number of withdrawals we can make. As I said, in the January 2023 pre-release, there was one of the 3 accounts that Luke had the option of taking, which only accepted 3 withdrawals per year. If you made a 4th one, the rate of interest you got was significantly reduced. So by accepting those restrictions, we might get a better interest rate. We can also manage our account online. Now, many of the new challenger banks, these are banks like Starling or Monzo, may offer a higher interest rate. The reason being is because they do not have any physical branches and as such they don't have very high overheads. That means that they have to make less profits in order to satisfy shareholders, and as such they may be inclined to give us a greater or preferential interest rate for managing our accounts online. But what alternatives are there to traditional savings accounts? Well, firstly, if we want something which is tax-free, we can use an ISA. There's a couple of different types. There's a cash ISA for people who are 16 and above. There's a stocks and shares ISA for people who are 18 and above. Or there are junior ISAs. Now, generally, if you have a traditional savings account, interest that you earn will be taxable. However, there is a tax-free allowance for any interests that you earn. At the moment, it's £2,000. However, it's due to go down very shortly, so keep your eyes peeled for if you generate a lot of interest for your savings. However, tax-free, therefore, accounts can be very attractive. The first type is cash ISAs. Now, this is for people who are 16 and above, and you can deposit up to £20,000 in this type of account per year. That's the maximum. Essentially, it stands for individual savings account, and any interest that you get from these accounts is tax-free. Stocks and shares ISA are slightly different in that, yes, they're individual savings accounts, but you can only get them from when you're 18. The reason why you can only get them from 18 is because the money you're putting into this account is then used by the bank on the stock market potentially, as they invest it on your behalf. Any return from the investment is also tax-free, but the reason why it's 18 plus is because you could make money, yes, but you could also lose money. And finally, junior ISAs. Junior ISAs are for people under the age of 16, and they often get better interest rates than the other two types of ISAs, so worth looking at if you are under the age of 16. NS&I products, now that stands for National Savings and Investment. The products that they offer, the most well-known product they offer is something called premium bonds. Now, premium bonds are seen as a more interesting way of saving than traditional savings accounts. Essentially, what happens is you can save up to £50,000 in this type of account, and for each pound that you invest, you get a unique code. That code is entered in each month to a lottery type game. The maximum amount that you can win as part of that game is £1 million, so a significant amount for £1 investment. Obviously, the more money you invest up to the £50,000 limit, the more chance you have of winning. However, the chance of winning with a single premium bond is about 34,500 to 1. Now, that's not to win the £1 million, by the way. That is to win any prize at all. Now, prizes go all the way down to the very low amounts, £25 for example. So at 34,500 to 1, there's quite a few £25 on offer, but only one or two premium bonds, premium prizes on offer each month. Cash is another way to save money. Put it in your piggy bank. Of course, it doesn't gain any interest that way, but you still hopefully have the same amount in that you saved. Of course, that means that inflation erodes the value of the cash over time. Essentially meaning that even if you put £100 in and after a year you take that £100 out, the purchasing power that £100 has is less than it was a year ago. And finally, investing in stocks and shares. Now, we'll look at this more when we come on to investment techniques in Unit 2. However, stocks and shares, essentially you're buying a portion, a small little stake and a bit of equity in a business. A small slice of pizza, if you want to think about it that way, in a business. You're buying a small amount. Of course, if that business does well, you now own a portion of it. So, in theory, that portion will go up in value and you can sell it for more later on down the line and make a profit. The potential return on stocks and share investment is significantly higher than traditional savings accounts. But just like the stocks and shares ISA, you could potentially lose money as well as make money. So it really depends on your attitude to risk. And finally, bonds and gilts. Now, this type of savings account or investment is an opportunity for people to invest money for the long term. So you can buy a bond, a corporate bond from a business, or a gilt from the government. Essentially what it is that business or the government giving you an IOU. Now, they sell these bonds and gilts and you can buy them as an individual, and you will get a certificate that says, yes, I've bought a bond or a gilt from this organisation or the government, and that certificate will say the amount you have invested, and it will say when your bond matures, essentially. So the date might be 2, 3, 5, 10, or more years in the future, and when it matures, that business or the government will pay you back your money. Now, why do people invest in bonds or gilts? Because in the interim, you will be paid a certain percentage rate. And that percentage rate is likely to be significantly higher than a traditional savings account. The reason being, you cannot access your savings for a significant, in some cases, period of time. Of course, the benefit of buying government gilts is, of course, there should be no chance of the government defaulting on paying you back. The reason being, if they haven't got enough money to pay back gilts, then they can increase taxes in order to raise that money. So, a key topic we need to consider when we are looking at savings accounts is the type of inflation. Now, inflation is the rising price of goods and services over time. And as prices rise, it reduces the purchasing power of money. There's several internal causes as well as external causes of inflation. So, for example, if businesses are paying higher wages, then people have more disposable income, they can buy more products, and therefore, if there's more demand, the price of them products goes up. On the flip side, external causes of inflation, it could be that things like wars or lack of supply increase oil and gas prices. Of course, we rely heavily on oil and gas prices, not just to heat our homes, but also petrol to put in our cars. And therefore, if there's an increase in prices, that will increase inflation. And therefore, the purchasing power of our money will go down. Inflation is measured in two different ways. Firstly, by the CPI, it stands for Consumer Price Index. And what that takes into account is a basket of goods that an individual may buy on a weekly or monthly basis, and essentially compares that basket to the basket in a month's time, in 6 months' time, etc., and sees how much the price of those goods have gone up. Retail Price Index, RPI, on the other hand, also includes some other things, including things like mortgage rates. So therefore, it includes more things. However, as less people have a mortgage, the ONS, the Office of National Statistics, prefers using CPI, the Consumer Price Index, as its measure of inflation. So, 3 multiple choice questions to double check your knowledge on topic 5. The first one, the interest rate quoted on a savings account is indicated by which of the following? Is it A, AER, B, APR, C, EAR, or D, RPI? The answer to question 1 is A. The AER stands for Annual Equivalent Rate, which enables savers to compare rates from different providers. Question number 2. A key feature of an individual savings account, or an ISA, is that A. The interest is always tax-free, B. The interest is paid every 3 months, C. The interest rate is guaranteed to be no less than the rate of inflation, or D. There is no maximum amount that can be deposited each year. The answer to question 2 is A. Interest paid on all ISAs is always tax-free. And the third question, when choosing a savings product, which of the following is not a relevant factor? A. How often withdrawals can be made. B. How the account is operated. C. Regular monthly fees. Or D. The the rate of return? The answer to question 3 is C. Savings products do not attract monthly fees. To be successful in your Part B exam, make sure you subscribe to this channel. I release videos including full evaluations of the case studies. In order to get the next video in this series, hit that banner.